Oh, hello, how are we doing Instagram? It's Monday, which means it's time for another edition, the 45th edition of the Monday Mortgage Melt. And as you can see, we are back in actually now sunny London. It was a bit dreary and horrible earlier on today, but it's actually a little bit nicer now. Even worse, because it is so warm and stuffy, is that in our offices, our serviced offices, I might add, the air conditioning is broken. So as you might be able to see, a little bit of sweat on the brow today, as we trudged through all of our mortgage and bridging and development finance applications that we've been working through today. It's been a very, very busy Monday at GUHQ. Lots of inquiries over the weekend. I actually opened my inbox to about 50 emails from over the weekend, although I finished up a little bit earlier than I normally did on Friday, so I think some of them might have hung over from Friday. But yeah, incredibly busy, but good to see you all starting to pile in. Thanks ever so much for joining, everyone. So as you guys may well know, if you're new, then listen in, because this is we'll do the housekeeping, I guess, to kick things off with. So this is known as the Monday Mortgage Melt. I use that terminology because I love a little bit of alliteration, but it's not just about mortgages. We're here to talk about all types of property finance. So today is a Q&A session. We do it every single Monday at 5 p.m. Hey, Barry Invest, how you doing? So we do this every Monday at 5 p.m, a big Q&A session. You guys can ask me anything you want with regards to property finance, and I will do my very, very best to answer all of your questions. So you're probably thinking, well, who the hell are you, and why should I listen to what you say and what you think about property finance? Well, my name's Sam. I am the owner and director of Grand Union Finance. We're a specialist mortgage brokerage that works specifically with investors and developers to help them succeed in their property businesses. I've been doing this for 14 years. We've just surpassed our first year anniversary at Grand Union Finance. So I know a little bit about property finance, and specifically the more sort of specialist nature of things, working, as I said, predominantly with investors and developers. So hopefully I shouldn't have any problems at all answering all of your questions. I'll try as best I possibly can, even though I'm absolutely sweltering in this non-air conditioned serviced office today. But yeah, if you want to ask a question, please don't put them in the comments. Feel free to use the comments in terms of chatting away and commenting on each other's questions, etc. But if you want to ask a question, put it in the little question box down at the bottom. Now, there's a very, very good reason for that, and that is because as people join, as you can see, their names pop up on the bottom. People are commenting on things, and as it goes along, I may well miss the question. And I don't want to do that. I want to answer all of your questions. So if you have one, use the question box below. I will get through as many as I can. We've probably got about half an hour today on today's session. If you join late and miss anything, I will be saving it and adding it over onto my IGTV and also on my YouTube channel as well. So you'll be able to check that out. So let's get going. I know I had a couple of questions, I think, earlier on from my stories. So let's take this one. I think this is from Picturesque Yorkshire off the top of my head. So, wanting to buy a rundown property, what do I need for it to be mortgageable? Really, really, really good question. Now, as a lot of you may well know, because I talk a lot about it, we do a ton, if not 50% of all of the transactions that we're involved with are to do with bridging or development finance. So you don't necessarily need the property to be mortgageable in order to get that type of finance. However, if you are looking to purchase a property with a mortgage, what does it need to look like? Well, to keep things really, really simple, most surveyors will put it as mortgageable, or can put it as mortgageable, if we hit three criteria points. Okay, so first one is it wind and watertight, i.e. if it pisses it down with rain, is someone getting wet? If that isn't the case, it's going to struggle. Next one is do you have a working bathroom? And the third one is, do you have a working kitchen? Because if you have a working kitchen and bathroom, that means that it's habitable. That means somebody could actually live in there. In fact, I think there's a rule something about it's actually illegal for somebody to live in a property if there's no working toilet. So I might be wrong. If anyone knows whether I'm right or wrong on that, please feel free to comment. When I did my first development many years ago, I remember that we left the property without a toilet for about a week or something, and our architect said, oh, you need to make sure that's sorted out, because you can't have anyone. I think we couldn't even have anyone working there because we didn't even have any toilet facilities. So luckily it was quite close to where my parents lived, so we were able to run home or to jump in our car and go home if we needed to use the facilities, so to speak. But what do I mean by a working kitchen and bathroom though? So basically it's, hey Caroline, how you doing? When I say working kitchen and bathroom, I literally mean do the taps work. And I'll tell you a funny story on this. About 2 years ago, I had a client that was buying a property probate. And I don't know if you've ever seen, when you go on Rightmove and stuff, sometimes you'll see sort of like yellow tape and stuff around certain like taps and things like that. And basically it's kind of to stop people using those taps because there's no utilities, and it's going through probate, or it's been repossessed or something like that. And sometimes they actually turn off the utilities so that physically no one can actually use them. Well, this property was actually immaculate. It was beautiful. I remember it was somebody buying it actually as a residential home for themselves. About 4-bedroom detached home, absolutely lovely. And because it had been repossessed, they had turned off the utilities. So when the surveyor went round, was looking around going, oh, lovely, this is nice, I wouldn't mind living here, turned on the tap and the water came out, they gave it a 0 valuation. They said it was unmortgageable because the utilities weren't turned on. I mean, for me, that's a bit stupid. Come on, the utilities are going to be turned on, it's okay. But yeah, they did. They gave it. They said it was unmortgageable. I mean, I had to call the underwriter and be like, I think you've hired an idiot as a surveyor. Quite clearly, the property is okay, and that we eventually managed to sort it out. The surveyor had to go round. Believe it or not, the surveyor had to go round and turn the taps on to make sure they actually worked. Yeah, that was a fun few weeks trying to sort all of that out. So in terms of what does it need to be mortgageable, as I said, just to sort of summarize 3 points there. Number one, it needs to be wind and watertight. So, no one wakes up in the morning lying in a puddle. And we need a working bathroom and we need a working kitchen. If we hit those 3 points, I mean, look, there are other reasons why it could be unmortgageable. There could be, severe damp. There could be, structural problems, all that kind of stuff. But in terms of the minimum criteria, hit those 3. If you're missing one, it's probably going to come back as unmortgageable. So hopefully that helps, guys. If you've got any comments on that, please leave them below. If you do have any questions, guys, I know Chinese Boys just added one. Please put them in the question box rather than in the comments, because otherwise I may miss it when I finally get round to it. So moving on to the next question. Here's an interesting one, and actually, Reese, I might not know the answer to this. At what stage would lenders stop lending on older properties, 1900 2000? I don't think they do, really. I've never seen anything written into criteria where a property is too old. Obviously, we have issues with leases, and if you're buying a leasehold property, if the lease is too short, that can cause problems. But I've never seen where a property is too old. I've often thought, actually, my wife's taste in properties is she loves like oldie-woldy cottages, and I'm maybe a little bit more modern. So I think we struggle sometimes. In terms of our tastes in these kinds of things, but I often, we'll often be like going out for country walks and stuff, and we'll see a beautiful old cottage, kind of Tudor-looking thing. In fact, last year we were in Ludlow, beautiful village stroke town, good brewery as well for anyone that's interested in Ludlow, and they've got some really lovely old proper old buildings. Those ones where they're kind of like, they've almost, the upstairs like jets out at the front, it's almost like a weird like bay window upstairs kind of scenario with like the black and white beams and all that kind of stuff. And I often think, who's lending on these properties? But I think as long as it's structurally sound, and it's not of it's of a standard if not non-standard construction, then really it should be okay. So I don't think the age of a property really creates an issue for a mortgage lender. It's going to be more making sure that that everything's structurally sound. I believe everything has a best before date. Yeah, but then again, look, the reason why you wouldn't drink milk that's gone past the best before date is because it tastes a bit funny and it smells a bit funny. But if it went after its best before date and it still tasted fine and smelt fine, then it should be all right. So I guess you could use the same logic when it comes to a property. The property itself is structurally sound. The property is of standard construction. Then if it was built in the 1700s, it wouldn't really make too much problem. So Reese, I've never come across that problem, if I'm honest. So I don't think it is one. But yeah, let me know if anyone's come across this before. If you tried to buy a property and the lender has come back and told you it's too old, there's probably a reason for it beyond the age. But obviously, the older the property gets, the more chance there might be of structural problems, etc. So obviously that's a potential problem. But hopefully that helped anyway, Reese. Right, on to the next. Here we go. Here we go. So Dara has asked, what's the best way to get finance for a commercial property we own and want to develop upstairs into 4 flats? Okay, good question. I love this kind of stuff. So essentially this is almost like a commercial, a semi sort of commercial to residential conversion. Now with something like this, you can either get some kind of bridging loan, or we would maybe look at development finance. Now, if you already own the property, and I was having this conversation with somebody last week actually, because of the way that development finance is arranged, whereby you get a facility of finance to draw down on throughout the course of the build to cover the building work, but you can also include what we call a day one advance on as part of the overall facility, and that's money that you would get day one. If you already own the property, and particularly if you don't have any or very low amount of gearing on it, i.e. you've got a small mortgage or only a very small amount of lending on it, or none at all, it actually means that you can borrow a nice chunk day one that would cover your initial build costs. Because what happens is that the development finance that you would borrow on something like this would actually be paid down. You'd say, for example, you needed 200 grand to do the conversion. The lender might say, right, well, we will lend this to you in 4 stage payments of £50,000 each. But what they don't tell you sometimes, and what a lot of people don't realise, is that gets paid in arrears. So what they will expect you to do is pay for the first 50 grand. Now, if you already own the property, and especially if it's unencumbered and you don't have any lending on it, that means you can actually borrow 50 grand day one and just make the development facility 150 grand instead of 200. So you're covered for all of the costs. Now, some people might say, well, one, I just borrow 200 grand as a bridge, and then I've got it in my back pocket, then I can do what I like with it. Well, yes, that could be something that you could look at doing. Lenders would still want to see the schedule of work. They would still want to see, everything that you're doing. They'd still want to be comfortable that you actually can do it, because them getting their money back is contingent on you getting the work done properly. But you start to pay interest on all that money day one. What's the point in that? You could do it on a development finance deal and actually borrow exactly the same money for exactly the same interest rate, and you'd end up paying less interest in terms of actual physical cash, because you only start paying interest when you draw down the funds. So if you borrowed 200k and you got 50k of that as a day one advance and 150 as a development finance deal, you only start paying interest day one on 50 grand, not 200 grand. So even if they're both 0.8% a month, for example, you're just paying 0.8% a month for the first 2 or 3 months on 50 grand. Then you draw down the next 50, and then you're paying it on 100. Then you draw down the next 50, and you're paying it on 150. Then you finally draw down the last one, and you're paying it on the whole lot. See what I mean? So we do this a lot. I have a lot of clients that will come to me and say, right, Sam, I need a bridging loan. And my first instinct is, but do you? I know I looked a bit creepy when I just did that. But I always try and think a bit more holistically when talking to clients about this kind of stuff, because if there is a way of doing something slightly different, I mean, look, this is maybe just me talking about kind of my approach to things, but if I've never been that guy that's kind of a human calculator. I'm not a very good yes man. Somebody comes to me with a problem, I try and solve it. And that doesn't necessarily mean that the answer to the riddle is what they have put forward. A lot of people come to me and say, I want to arrange this type of finance? And my first instinct is always, well, let's do a little bit of research on this first. Let's dig deep into what we're doing here, and let's actually arrange some finance based on what you really need, not necessarily what you think you need. So in answer to this question, what's the best way to get finance for a commercial property we own and want to develop upstairs into 4 flats, is development finance all the way. If you've got finance already on it, we can get a day one advance to cover and pay that off, because we can't keep the existing finance that's on a building like that. That needs to be removed. We need to get development finance in, cover the day one, pay, get a development facility to cover the cost of the works, and then what we can do is we can get a semi-commercial mortgage across the entire thing at the end. Or if you want to split the titles into 2, you can have or you can split the titles into 5 even, the 4 flats above and the commercial downstairs. Then you can probably get a multi-unit freehold mortgage, which similar rates to an HMO on the top bit, and then we can get a commercial on the bottom. In fact, if it actually works out, and I've done this a few times, it's cheaper to get residential funding than it is to get commercial funding. So if you're going to do a project like this, what you can do is you can just get a mortgage based on the residential upstairs, and you might not even need to get a mortgage on the downstairs, because it might be enough to pay off the development finance that you've taken out. So if we can do that, it's better all round. You've got an unencumbered property downstairs, which isn't then reliant on you having, a long lease, because commercial finance is based on the quality of the lease, not on just the bricks and mortar value, because really, actually, commercial property that's just bricks and mortar has actually quite a low value from a lender's perspective. So, and that's why you see empty commercial properties selling for quite small amounts on Rightmove, etc., because until they've got a tenant in it, they don't really actually have a value, or very little value. So if we can wrangle it so that the properties upstairs, once refinanced, could actually pay everything off, we can leave the downstairs, the ground floor commercial unencumbered, and it means you're not having to pay commercial rates of 5% plus. So that's how I do it. That is how I would do it. Just as a side note, development finance is based the total loan facility, so that's the development finance facility that covers the cost and the day one advance together, cannot generally exceed 60 to 70% of the GDV. That's gross development value, people. Let's not use done up value, because that's a surefire way of telling lenders that you've been doing a course. GDV, gross development value, that's the end value, basically. So a percentage of that is what the overall development finance facility will be based on. Right, next question. It's my French accent there. I don't know if any of you realise that. Okay, Avi Official has asked, what alternatives or add-ons to a mortgage could you recommend when raising money for a property purchase which is going to be a buy-to-let? So let's go into this in a little bit more detail. So what alternatives or add-ons to a mortgage could you recommend when raising money for a property purchase? So I'm guessing, because you've said sort of add-ons, etc., that maybe what we're talking about here is that you have an existing property, and we need to try and maybe raise some additional cash that can go towards a property purchase. So there's kind of 3 ways of doing this. The first way, which doesn't really involve me as a broker, but I always let my clients know about it, because I don't really care I've got to give them the right advice, basically. It's not about me earning money all the time. It's just about me giving the right advice to clients. So first one is go to your existing lender and ask for a further advance. You can do that by simply ringing them up and saying, can you let me know about how I could go about getting a further advance or applying for a further advance? Somebody should be able to give you a ton of information about that. It will still have limits on the loan to value. I had someone recently say, ask me about borrowing 100% of the value of a property. I was like, that's not how it works, unfortunately. It will still be based on a maximum loan to value, generally speaking, probably about 75%. So if you're already leveraged up to quite a high amount, generally speaking, you won't be able to borrow any more money potentially. But if you're leveraged at, say, 50%, for example, they might lend you a further 15% of the value of the property as a further advance, potentially based on the same interest rate that you're currently on, and there you go, sorted. That's probably the easiest way of doing it. The other 2 ways are to get further borrowing from a different lender. Now, the first one that we would do, or the first way that we would do this, is via what we would call a second charge term loan, and that is basically a second charge mortgage. So Generally speaking, 10 to 15 years on a term, interest only, 6 to 9% interest roughly at the moment, maybe slightly less, but roughly that's what you're looking at. And again, same sort of loan to value. Some of them might push to 80%, but generally speaking, 75% overall is what we're looking at. Hey Wolf Property, how are we doing? And that's what we'll be looking at, okay? So, and that's when we're doing it. Interest only payments per month, you know, servicing the debt, etc., etc. If it's on your own main residence, of course, chances are it will probably be, we might be able to go to a higher loan to value, so it could go up to 90%. It will be subject to affordability though. So you've got to show that it's affordable in the same way that your standard residential mortgage would have been. That goes for the same for your further advance, by the way, as well. Sorry, I didn't mention that earlier on. So so they're two ways that you can get kind of mortgage finance based on affordability, based on limitations on loan to value, obviously. The third way, which is the more kind of creative way, I suppose, is we can actually get a second charge bridge. Now, traditionally, any funding that's secured against your own main residence is regulated by the Financial Conduct Authority. Anything that isn't your own main residence is not regulated by the Financial Conduct Authority, FCA, and we call that unregulated lending. It's not unregulated, it's just not regulated by the FCA, it's regulated by the PRA instead. But there is a loophole here. If you are, I say loophole, it makes it sound naughty. It's not naughty at all, it's just what's allowed, if you are raising a bridge on your main residence as a second charge, and the use of that funds is for business purposes. Now, bearing in mind, if you're buying another property through a limited company, where's that money going? Into a business. So it's technically raising funds for business purposes, and that means that it's deemed to be unregulated. So it's the only type of lending you can secure against your own main residence that will be deemed to be unregulated. Why do we care whether it's unregulated or not? Well, we care for a couple of reasons. Number one, we've got much fewer hoops to jump through. Couldn't get my words out then. Much fewer hoops to jump through, and we have more access to more lenders, because most of the bridging market is unregulated or aren't regulated by the FCA. As I said, we're not living in the Wild West anymore. These lenders are regulated just by different regulatory body or governing body, the PRA, Prudential Regulatory Authority. Lots of difficult words for me to say today on a Monday afternoon when I'm swelteringly hot because my blooming air conditioning isn't working in my office. So yeah, challenging myself. So that is our third and final way of how we can raise finance on a main residence to go towards another property purchase. But again, we are limited by loan to value again. So I've actually been looking at one of these today, and realistically, we're going to be limited to 75%. I actually reckon we might be limited to 70%. If the loan size is less than 100k, I think we are going to be going down the route of 70% overall loan to value limit. So that's including your first charge mortgage as well. So we add the two together, and both of them together need to be below 70%. So, Avi, I hope that was helpful, and I hope I got the question right as well. Some of these questions I need to kind of interpret, because I know that there isn't a lot of space to write everything down. But let's get on to the next question, because we've only got about 10 minutes remaining, because I've got work to do and stuff. Right, so let's. TJ has asked, can you bridge on a tenanted property or arrange bridge on vacant possession, I'm assuming? Yes and yes. So whether a property is vacant or not vacant, you can still get a bridging loan against it. Now, the one question that a bridging lender may well ask if you're buying a tenanted property is, and you are planning to refurbish it, raise the value, i.e. BRR type strategy, and refinance it at the back end, what they might be struggling with is, how are you going to do the refurbishment if the property is tenanted? That is a question that we are asked a lot. The answer has, I've seen plenty of these, even to the point where about last year, had a client, was it last year, year before? I suppose it doesn't really matter, but last year or year before, had a client buying a tenanted property. In fact, it was multi-tenanted property, because it was a block of flats, about 6 units in there, 3 were tenanted, and he was going to renovate every single one of them. Now, what we actually did on this was he renovated the 3 that were dormant, empty, vacant, and then he moved in the 3 that were living in the shitholes into the nicer properties. He kept their rent the same as a thank you, and then he renovated the other 3, and then once they were renovated, he tenanted them, and then we got a new mortgage, a multi-unit freehold, or MUF, or MUF, as you might want to call it, mortgage, which basically is a loan against the entire freehold of a block of flats, and then we did it that way. So there's you can be a bit creative. Bridging lenders are so flexible anyway. As long as they can see a genuine exit and how they can get their money back, then they can be really, really flexible, TJ. So hopefully that helped. Okay, not too long left to go now, so let me just go through. So Chris Gregory has asked, how are HMO valuations calculated? This is a really, really good question, and I would split this into 2, Chris, which is number 1 is if they are, we're going to talk about non-Article 4 areas at the moment, but if you are looking at a small HMO, so below 6 bedrooms or less, this will fall into a C4 categorisation. Outside of Article 4, C3 to C4, so C3 family home and C4 HMO can be done via permitted development rights. So it means that from a commercial lender's point of view, doing a commercial sort of yield-based valuation is quite risky, because if they lent to you based on a commercial yield-based valuation and then you decided, actually, I don't like this HMO malarkey, I'm going to just put this back into a family residence, then what will happen is potentially you could be leveraged at 90, 100, 110% loan to value, and that's going to be a massive risk to a lender. So generally speaking, if it is in a non-Article 4 area, C4 classification, we're going to look at a bricks and mortar valuation. A specialist surveyor that works with HMOs will be sent out to the property, so it's not just going to be based on, right, this is a 4-bed house, so it's going to be done as a 4-bed, going to be valued as a standard family 4-bed house. They will take into account the fact that this is an HMO. But generally speaking, it is it will be done on a bricks and mortar basis. If it is if it's 7 bedrooms or more, and you need planning permission to get that, by the way, it will fall into the category of sui generis, which I believe in Latin means no classification, or without classification, or something like that. Then we can look at getting a yield-based valuation. Now, I actually did a post on this a couple of weeks ago, so you might want to go and check this out. I thought it was quite a good post anyway, all about how yield-based valuations are calculated. And essentially what it is we look at we work out what the yield is in terms of the income generated as a percentage of the annual income generated as a percentage of the bricks and mortar value, and then what we'll do is we will take the income that's generated over the course of a year. We will deduct the sort of the standard expenses. So generally, most lenders work at about 20-25% of that as normal expenditure, and then we divide that by the yield, and that gives us a yield-based valuation of the property, which generally, if the yield is sort of usually above 5%, then generally that means that the yield-based valuation ends up being a little bit higher than the bricks and mortar. If it's below, generally the bricks and mortar is a little bit higher. So they're the 2 ways that an HMO valuation is calculated. It's either done on a bricks and mortar, or it's done on a yield-based valuation. To get a yield-based valuation, by the way, you need to use a commercial lender. You won't get it with your buy-to-let lenders that do HMO mortgages, just as an FYI. So hopefully that was helpful. Okay, I think I've got time for one more question. Another one from TJ, which is, can we get a refurbishment buy-to-let bridge as long as the work is done in less than 5 to 6 weeks? So good question. Refurbishment buy-to-let bridge. So effectively what we're talking about here is there's two different products that we're talking about here, TJ. So product number one is a buy-to-let mortgage, and product number two is a refurbishment bridge. So you can get a buy-to-let mortgage if we hit, and we're doing sort of a BRR type strategy, if we hit two criteria points. Criteria point number one, we're not going to refinance before the end of the fixed rate period. So if you're going for a 2-year fixed rate, don't do it before 2 years. 1 year, there are, I think, a couple of products that are on 1 year. Then pre 1 year, you've got to hang on to the property for the fixed rate period. And number two is how long is the refurb actually going to take? Now you put 5 to 6 weeks. I say 4 to 6 weeks. So yeah, basically, if the surveyor, it's down to the surveyor's comments. It's like the lenders get out a free jail card. Oh, subject to valuer's comments, we can do that. So if the valuer says, there's only a little bit of work that needs to be done on this, it can be rented out relatively quickly, and they think the work's going to take less than 4 to 6 weeks. Generally speaking, they'll be okay. If they don't think it's going to be okay, then they will either give it a 0 valuation because it doesn't meet the criteria of the lender, or the lender themselves will put what we call a retention on the funds, which means they won't lend you the money unless some works are done, which is kind of a bit cat and mouse then, because, well, you can't do the works until you buy the property. You can't buy the property until you get the funds, but you can't get the funds until you've done the work, and you're going round and round and round and round in circles, and you get a big headache. But a refurbishment bridging loan, which is something slightly different, is when we actually borrow a certain percentage of our day one net advance is going towards the cost of the work. So if, for example, we were buying at 100 grand and the loan, we wanted to get an 85% loan to value refurbishment bridge. 75% of that technically is towards the day one value, and the remaining 10% is meant to be a contribution towards the works. Now that's going to work out to be 10 grand. So if the works are less than 10 grand, say they're 6 grand, they would only lend you 6. So they won't go to the full 85%. If it's above, then they will limit it to the 10, essentially. So two quite different products, but essentially, if you're looking to refurbish a property and you want to try and go in with a buy-to-let mortgage, you just have to hit those two points, basically. So hopefully that was helpful, TJ. Okay, we've got one last question, but only just because it's from TX Wonga, who I like very much. So, do you think that because BRRs are becoming popular and everyone is slowly starting to do it, there will eventually be some sort of restriction in future as you receive a huge sum of money tax-free? I don't think you do receive a huge amount of money tax-free. I am not a tax advisor though, so I can't comment on that. But in terms of just kind of the popularity of things, let's put this into perspective, okay? So obviously, like myself and a lot of you guys that are watching this will be involved in property in some way, okay? So we're in the zone. We're in the community, okay? So we think things like BRR, buying property in limited company, HMOs, holiday lets or service accommodation, these are all like normal things. They're not. Okay, so let's put this in context. Not so long ago, I spoke to my contact at BM Solutions, or Birmingham Midshires, for the uninitiated, and bearing in mind, when I first started brokering, well, I got into the industry 2007, which makes me feel extremely old. BM Solutions, Birmingham Midshires were like the go-to buy-to-let mortgage company, and they're now one of the few kind of, again, specialist buy-to-let lenders that don't lend to limited companies. And I was talking to my contact over there, and I said, why do you not? Why, you're falling behind. I mean, to be honest with you, there's a lot of reasons why BM are falling behind. They haven't updated their system in like 10 years. Used to be amazing, just now completely fallen behind, which is a good lesson in making sure that you're always innovating and always pressing forward, because they were the best, they're not anymore. And I was asking about this, and they said, well, actually, Sam, of all the buy-to-let transactions currently that use a mortgage, less than 10% are done through limited company. And I was absolutely blown away by that fact, because probably 90% of the transactions I'm involved with are done in limited company now. And so hence why, so I always speak to my clients and go, you do know that now you've got a company, there's so many things you can do. You can run your insurances through it. You can run your pension through it. It's all tax deductible. I can't give tax advice, by the way, people, but we sort all that kind of stuff out as well. So there's loads of other things that you can do to make your life a hell of a lot better financially by having a limited company. But yeah, less than 10% of all buy-to-let mortgage transactions are through limited company still. So that gives you a bit of context to this whole, we think everyone's doing BRR. They are not. When people say, that market's saturated, it's not. It really isn't. So many fewer people are doing it than you think they are. Do you know that probably 1% of the country even understand property investing? 1%. If you are able to do HMOs, you're in the top 0.5%. If you are able to do commercial to residential conversions, you're in the top 0.25%. We don't realise how the knowledge that we have is actually exceptional. It really is. So, like I said, just giving a bit of context to that, TX, is that generally speaking, it is becoming popular, but, it's not as popular as buying a residential home. It's not as popular as getting a job, and it's not as popular as retiring at 75 and not having enough money to feed your family. So you are in the top 1% if you're doing this kind of stuff, and you should remember that. You're exceptional people for looking outside of the norms of the confines of our society.